we are maintaining a slightly pro-risk bias in our multi-asset portfolios. At the same time, we are thinking about hedges. The hedges we are thinking about is overweighting long-term U.S. Treasuries because they always react favorably whenever equities sell off more than 2 to 3% in a month. We are looking at adding oil equities because oil equities have not done well to the course of last year. Earnings have been slashed dramatically. And if this environment persists, where the geopolitical risk premium on oil prices is high, then they should do well in their role to hedge the generic risk that you have in the portfolio through an overweight in equities. And the third element that you could think of is allocating some money to gold. Gold did very well last year. Fundamentally, if economic growth recovers, it should not do well. But if geopolitical tensions stay, then gold prices should do well.
Are you actively recalibrating your risk stance as far as managing your portfolio is concerned? And have you been doing so over the course of the last 7 sessions, 7 days, ever since the story broke to the screen? Do you believe that it's time to kind of spread your risk and take more exposure to bonds, to currencies, the safe haven plays?
Yes, absolutely. We had a long meeting just yesterday evaluating the economic backdrop, which is positive, against what's going on the geopolitical side. And what we came up with was potential hedges that I described earlier. We are definitely going to allocate more money to sovereign fixed income in the U.S. We are looking to allocate to oil equities specifically as a hedge against our overweight equity stance. So this is, again, an evolving situation. It's possible that the two sides meet. The two sides kind of withdraw after the initial round of attacks on each other. It's possible that plays out. It just remains a war of words. And we're used to war of words. 2019 was a war of words and trade on tensions between U.S. and Iran. So the markets will overlook that. But if it does get worse from here in terms of the U.S. tracking back at Iran, then we need these hedges to come good in the portfolio.
And Binay, as you talk about, hopes for an improving economic outlook, that certainly was a theme kicking off the new year before these escalations, some of the green shoots and the data we saw out here in Asia as well. Do you worry that some of those don't look so bright if the consumer doesn't hold up here in light of this uncertainty, if oil prices spike, if we start to see some concerns about flying and traveling as well?
Yes, oil prices at 70 are manageable according to us. But if they start moving up towards 80, then they start becoming problematic because they start hitting the wallets of consumers. And let's not forget that consumers were pretty strong in the US last year. They were pretty strong in Europe as well. And they didn't do too poorly in China as well. So therefore, you need consumers to be happy, and you need less of an oil tax on their pockets going into 2020. Because if that does happen, if they start paying a lot more for consumption of oil, of energy, then it'll slow down the growth recovery.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.